How business owners and corporations use whole life insurance. Now, business owners, when purchasing high cash value life insurance for their company, perhaps on their executives or key members, are often very focused and very interested in the cash value. Maximize that cash value. It's an asset on the balance sheet. If I've got excess funds in cash, I actually see it grow in a policy where I still reap the same benefits as far as it being safe, liquid. I've got the tax-free benefit as well, and the life insurance comes into play. But how do we organize it more? If you're a business owner and you're looking at, okay, I like this idea of high cash value life insurance if I just focus on the core benefits. What do I have here? I want to make sure it's set up right. What do I look for? If I go back to this in a properly designed policy design, maximum cash value, company selection, and then the last one, flexibility is huge for many businesses, whether they've got $1 million plus or 10 million in the bank, or they don't. Maybe some months are very good, other months not so much. Flexibility is huge. So what to look for specifically? Often, when we design policies for corporations, executive benefit or SERPs, supplemental executive retirement plans, here's what you'll see. And really, when we always talk about maximum cash value policies, this is where it all started, where I obtained a lot of knowledge on all of this. When I say all of this, cash value life insurance started with companies. They'd first look for this, 85 to 90% of their payment in cash value right off the bat with traditional whole life products. And sometimes, like the last video we looked at with the dentist, 95% right off the bat. Depends on their need there and if they want more upfront or more long-term. Break-even point, typically between years 3 and 5, and then flexibility, not locked in to high payments or high bill. And what you'll notice with larger businesses, larger corporations, is the company selection is not even a question. They know what to look for from prior experience, or if they've hired a CFO who's coming from another company. We see this with banks, Mass Guardian, New York Life, Northwestern Mutual. There's a reason. The actual performance is there. Financial ratings, safety ratings, all that stuff is great, but cream of the crop in terms of quality here. All three of them is particularly appealing to business owners and companies. So how do companies actually use it? Because I can own a business, pump money into a cash value life insurance policy, and use that really as my line of credit for financing, for hiring more employees. I can use the cash value in some ways as an alternative to a bank account, but it goes much further than that. We're gonna have some fun and break down exactly how corporations structure these products. So typically, if you have a business or corporation, you've got the policy owner being the company. So if you own a company and you're going to take policies out on yourself or other members of your corporation, you will own the life insurance policy. The insured will often be your employees, and this can be executives. You've got complete control over who these policies are actually on. So let's say you've got 5 leaders at your company, people that just take that initiative, go forward, they run it even without you, like, man, I want to keep these people here forever. These are the 5 people you're going to take these policies out on. Let's assume you are contributing $100,000 per year on all of them or each of them. Depends on the company size and what the plan looks like. Now, quick side note here, there's no tax deduction on these plans. So the policy, like a traditional individually owned policy, is funded with after-tax dollars and then grows tax deferred, but can be accessed tax-free anytime. But in order to have that access, we cannot deduct the full $100,000 payment. The cash value is an asset on the company's balance sheet. So you own the company, so it's an asset on your balance sheet. And then you've got the death benefit here as well on the insured, the 5 executives. So a couple bullet points here I want to touch on. As the business owner, the company, you have access to the cash value. Again, the asset is an asset. The cash value is an asset on your balance sheet. Looks good, continues to appreciate. You have access to it anytime. Key man coverage is established immediately. So if you make a $100,000 payment and executive number 1 has a $2.5 million death benefit and he dies tomorrow or next year, that $2.5 million death benefit comes where? Income tax-free back to the company. This way you can use those funds to begin to look for his or her replacement. Non-qualified. So 1, that means we cannot deduct the payments, but 2, it also means we can offer to select employees. If we offer to one employee, we are not required to offer to all employees. That's a nice option there, especially if we're looking at larger payments. This is where a lot of companies use this. So nice bullet points there. Now, here's the thing. If you own a company and you say to me, Steve, I'm going to take this policy out on you. And I, the company, am going to pay the premium. I, the company, am going to reap the benefits from the cash value. Steve, if you die, I, the company, am going to cash in. I'm the beneficiary on this life insurance policy. Steve, you might have to go through a medical exam, you might not, but you do have to sign off on paperwork acknowledging that you want the policy. What am I, Steve, going to say to you? What's in it for me? Like, what are you just going to kill me off to get this big death benefit? Like, I get that it's good for the company, but what benefit is it to me to allow you to take this life insurance policy out on me? So here's how these plans work. So you, the business owner, would say to me, Steve, I'm going to set a vesting period. This is set by you, the company. That vesting period could be performance-based. It could be until I'm 65 years old. Could be 10 years. You set that time period. It is completely in your control. Now, I must stay with the company and perform based on that vesting requirement there. And if I do so, I'm rewarded by you. If I leave, however, if I say, you know what, I'm done, I'm going to go start my own company and compete against you. Or I'm going to go work for your biggest competition because they just came in and offered me the world. Well, once this plan is in force, if I do that, I'm going to walk away from that reward or that benefit. So how this works is just like this. Let's look at exactly what that benefit is. So what you say to me to prevent me from ever leaving your company, you say, Steve, if you stay with the company until age 65, let's assume that that is the vesting period, I, the company, am going to pay you, Steve, a retirement benefit of $50,000 per year for the rest of your life, or maybe till age 90. Really doesn't matter. Okay, that retirement benefit or that $50,000 payment is paid from the cash value of the life insurance policy you had built up over time. The advantage to that is I'm retired now. I'm no longer producing revenue for your company, so it does not impact company revenue. This is still tax deductible to the company as a compensation expense. So if you're compensating me, you've got a tax deduction there. However, it is taxable to me, the retired employee, as ordinary income. So as the business owner, the company, when you take a distribution, whether that is a withdrawal or if it's a policy loan, that is a tax-free distribution to you, the policy owner. You've funded that policy with after-tax dollars, have access to it tax-free. When you pull that out, no taxes. When you pay it to me, results in a tax deduction to me or to you, the company, and then it is taxable as income to me as the retired employee. And here's the thing on the end. We always require a death benefit is left on in order to have what is called cost recovery, and we want to account for inflation. What that means is if I die at age 85, let's say age 90, I want to make sure, or you, the company, wants to make sure a death benefit is still intact to flow back to the company, income tax-free, and recover those premium payments you made and some, and inflation, even though you had cash value all the way through. Let's take a quick look here because this will be interesting. So we've got a policy on a 50-year-old executive. So the company, the corporation, owns the life insurance policy. Company makes the payments, in this example, $100,000 per year for 7 years. Immediately, $100K goes in, about 89% in cash value. That could be higher to sacrifice long-term performance, depends on the company, but we've got 89% immediately. What is highlighted in yellow is when we are positive. So between years 3 and 4, we have more money in cash value relative to what we've paid in. So this is an example, just pumping money in, letting it sit and grow. We also have that immediate death benefit of $2.25 million. Example on the right is going to demonstrate the actual income payments. So if this was your employee, you took this policy out on them when they were 50 years old, funded it for 7 years, could be shorter or longer. This could be flexible as well. What do we notice? Age 65, we are going to begin taking income from the product. Now that column in bold blue represents the total payments you, the company, made to this policy. And that's important to be aware of due to the cost recovery aspect we're going to look at. Eventually you want that money back. So you want to retain the employee, pay them out, reward them in retirement, and get your money back. You've paid $700 total in. Age 65. You begin to pull out $50,000 per year and pay it to him. This is the benefit. You say, hey, thanks so much for helping the company grow over the years. Here's your additional reward in addition to everything else, the bonuses, other retirement plans. You've got this supplemental retirement payout, 50 grand per year. The company would take this out through pure withdrawals up to cost basis, up to the $700,000. And then begin to loan out the rest, which doesn't matter to the executive. He's still getting $50,000 per year. But here's the fun part here. So the company paid in $700,000. They distributed $50,000 per year. By age 90, we're going to assume death or expiration. Here we go. Paid in $700,000, pulled that out, and an additional $550,000. For the retired executive, he received a total of $1.25 million in payments throughout the duration of his retirement. Now, we did not just drain the cash value in these plans. We typically do not. The reason why, we still have a healthy amount of cash value remaining at age 90. But if he dies, let's say the next year, we paid in a total of $700,000. Granted, this is 40 years later, we get a death benefit completely income tax-free of $1.1 million. And granted, that figure is going to be different over time as dividend scales are going to adjust over 40 years. But still, conceptually, when we design these plans, that death benefit must not only recover the costs, but we also want to account for inflation as the dollar, we know how that works actually. I'm not going to get into detail there. But overall, this is a great strategy companies use to retain and then reward their employees and executives on the back end. And the beauty to this is about the additional benefit with our top talent. All the way through, we have access to that cash value. Perhaps I'm leveraging it as a line of credit for other opportunities in my business to continue to grow. I've got access to the capital all the way through. So really powerful strategies that can be implemented by business owners. This is one of my favorite things to go through. I've always enjoyed this. But if you have any questions, would like more information, please reach out anytime. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.